Welcome, Curious Minds, to another deep dive. Today we're taking a really close look at Westlife Foodworld Ltd.
Yep, the folks running McDonald's in West and South India.
Exactly. We've got quite a bit to work with here. Their Q1 FY26 earnings presentation, the official results, press release.
And even the full earnings call transcript, which is always revealing.
It is. So our mission today, really cut through the corporate jargon and the big numbers. We want to bring you the key takeaways, maybe some surprising bits, about how they did between April and June 2025. Think of it as your quick guide.
Yeah, and what's great is these docs let us see beyond just the headline numbers. We can look at the strategy shifts, how they're operating day to day, and the consumer trends really shaping things for them. It's not just what happened, but why it matters for India's whole consumption picture.
Okay, so let's kick things off with the big picture then. Westlife Foodworld reported total revenue of $6.6 billion for the quarter.
Which is up 6.7% year on year. Decent growth.
Decent growth, yeah. But here's what caught my eye. The same-store sales growth, SSSG, it came in at 0.5%. Now, what does that tell us? Especially as it's their third positive quarter in a row for SSSG.
That's actually pretty important. Management called the environment stable but soft, right? With muted macro trends. So getting any positive SSSG, even just 0.5% for 3 straight quarters, well, it signals resilience. It means they kept guest numbers steady, check sizes steady, even with people being careful about spending. That's not easy.
Right. In a tougher market, you might expect that to dip negative.
Exactly. So 0.5% is actually quite telling.
Okay, digging a bit deeper into the financials. Operating EBITDA, that's a key profit measure.
Right. Earnings before interest, taxes, depreciation, amortization.
Stood at $855 million. That's up 6.9% year on year, holding a 13% margin.
And that stable margin is interesting.
It is. And cash profit after tax, was $474 million, or 7.2% of sales. So that stable 13% EBITDA margin, what does that really signal? Operational discipline.
Absolutely. Maintaining that margin and growing the cash profit, even moderately, it just says a lot about their cost control. It shows a solid business structure underneath. They're managing the ship well, even with, external headwinds. Strong operational control.
So how do they actually, get this revenue? They split sales into on-premise and off-premise.
Dine-in versus delivery and takeaway, basically.
So on-premise, dine-in grew 8% year on year, made up 59% of total sales.
Okay, so more people eating in.
Seems like it.
Huh.
Meanwhile, off-premise delivery, takeaway that grew 4% year on year, contributing 41%. So what's this mix telling us about how people are eating now?
Well, it looks like a balanced approach is working for them. The stronger growth in dine-in, the 8%, suggests people are coming back for that in-restaurant experience. Maybe the value's hitting home now. But the off-premise holding steady at 41%, which they said is in line with their 3-year average, that validates their whole omni-channel setup. Delivery and takeaway are still crucial, so they're catering to both needs, which is smart.
And here's a number that really jumped out at me. Digital sales, about 75% of their total sales.
Wow, 75%.
Yeah. Growing over 500 basis points, that's 5 percentage points year on year, driven by their apps and the self-ordering kiosks, the SOKs.
Okay.
They've got over 44 million app downloads now, cumulative, and over 3 million monthly active users.
What's the real strategic value there? It's huge, right?
Oh, it's massive. 75% digital penetration.
Yep.
That means they probably have one of the most digitally advanced QSR networks out there. Anywhere, really.
Yeah.
And the key thing isn't just the sales channel, it's the data. It lets them personalize offers, understand what people want, drive repeat visits. It builds loyalty. It optimizes everything. That digital backbone is a huge, huge competitive edge.
Okay, let's unpack profitability a bit more. Gross margin. It went up 160 basis points, 1.6% sequentially, hit a historic high of 71.6%.
71.6% gross margin. That's really strong for QSR. It is. And they put it down mainly to significant enhancements in supply chain efficiencies. Now, how sustainable is that? And how do you think they're actually doing it?
Well, management seems pretty confident. They said they believe it is sustainable. They expect it to stay above 70%, maybe even improve if volumes pick up more.
Okay.
This suggests it's not just a one-off lucky break. It's structural changes. Probably leveraging their buying power, better logistics, maybe using tech in the supply chain, renegotiating things. It's a core part of their strategy cost leadership. Lets them offer value, but still keep margins healthy.
Right. And related to that, restaurant operating margin, ROM, that was up too by about 80 basis points. Driven by operational excellence, they said.
Efficiency in the stores themselves.
But general and admin costs, G&A, were a bit higher this quarter. What was going on there?
Yeah, they mentioned that. Said it was down to upfront investments, things like strategic projects and people-related costs.
So spending money to make money later kind of thing.
Basically, yeah. It suggests they're investing in future capabilities, maybe new tech rollouts, talent development, that sort of thing, even while keeping store operations tight. So building for the future, expecting those benefits to show up in the coming quarters.
Okay. Moving beyond just the numbers.
Yeah,
Strategy. This directly impacts us as customers, right?
sure.
They talked about strengthening their core with value and product innovation.
Right.
So the McSaver meals, the McSaver Plus combos, those kept driving affordability and getting people in the door.
The value platforms are key.
Yeah. And then they had that limited time Korean range, burgers, sides, drinks, launched back in March. He said it got good traction. So this mix of value and new stuff, what does it signal?
It shows they really get the current market. Affordability is crucial, no doubt, but people also want something new, something exciting. So they're doing both, anchoring with value like McSaver, but then creating buzz with limited offers like the Korean range. They called it holistic value. It's not just price. And those limited offers, great way to test the waters for new permanent items too. Very smart.
Let's talk expansion. They added 9 new restaurants this quarter. Total count is now 444 across 71 cities.
Steady pace.
And they crossed 100 drive-thrus and now have 106. That's about a quarter of their restaurants.
Drive-thrus are clearly important.
Definitely. And almost all stores, 99%, are now Experience of the Future, EOTF, modern design, digital kiosks.
Right, the modern setup.
And 96% have McCafes. So this specific expansion mix, drive-thrus, EOTF, McCafe, what's the long-term play there for customer experience?
It paints a clear picture. They're expanding carefully, hitting new areas, but also strengthening where they are. But it's how they're expanding. The focus on drive-thrus is convenience. McCafe adds another reason to visit, maybe at different times of day. And EOTF is about modern experience, efficiency, digital integration.
Right.
It all feeds into building this robust multi-channel offering, making it easy and appealing to visit however you want to do it. Lines up with that big 2027 target of 580, 630 restaurants.
Now, here's something really interesting that came out, especially on the earnings call. Management specifically mentioned immense potential in the South market.
Ah, the South. Yes.
They've decided to put in a new business officer structure down there. Basically, strengthen the regional leadership to really understand local tastes, speed up decisions, make operations better specifically for the South. Why is this regional focus so critical now?
It's super critical. They basically admitted the South was dragging down their overall SSSG. The West was doing fine, but the South was lagging.
Okay.
So this isn't just tweaking things. It's a major strategic investment, recognizing that India isn't one single market. Tastes, habits, they vary. Putting a dedicated team there, that's about getting closer to the Southern consumer, adapting the menu, the marketing, whatever's needed.
Is there a risk it won't work?
There's always a risk. Maybe habits are harder to change or it takes time. But they sounded confident. Said they were already seeing green shoots from experiments there. If they crack the code in the South, it could really boost their overall growth significantly. Feels like a calculated bet.
And looking even further ahead, they're setting up a new vertical focused solely on long-term initiatives. They called it Horizon 2 projects. Looking beyond 2027, what does that signal?
That signals they're not just focused on the next quarter or even the next couple of years. Horizon 2 usually means stuff that's more exploratory, maybe higher risk, but potentially transformative.
Like what, potentially?
Could be anything for a QSR. Advanced AI for hyper-personalization, major breakthroughs in sustainable packaging, exploring completely new food categories or service models, maybe even ghost kitchens beyond just delivery. It's about laying groundwork now to make sure they're still leading the market 5-10 years down the line. Future-proofing, basically.
Okay. Shifting gears slightly, shareholder value. The board approved an interim dividend, 0.75 per share.
Yep. Base value of €. Record date August 4th. Payment by August 22nd, 2025.
So, sending some cash back to investors.
Yeah, it's a sign of confidence, right? Shows they feel financially strong enough to do that, even with the market being a bit soft. Keeps shareholders happy.
And on a different note, but still important, culture. They ranked 33rd among India's best companies to work for. What does that tell us?
That's actually a really big deal. It reflects well on their internal culture, probably means good employee morale, engagement, what they called a people-first culture.
Does it have business benefits?
Oh, absolutely. Happy, engaged employees. They usually provide better customer service. It helps attract and keep good talent. reduces turnover costs. It often translates, maybe indirectly, but translates to better performance overall.
Right, makes sense. Okay, so looking ahead, what's the management vibe for the rest of this financial year, FY26 and beyond?
They sound pretty optimistic, actually, talking about progressively improving momentum. They expect eating out to pick up, maybe helped by lower inflation, potential government stimulus.
They actually said, the bottom has already passed us.
Yeah, which is a strong statement. Now, is that just hope, or is it based on solid ground?
That's the question, yeah. Given the macro picture, still seems a bit uncertain.
Well, they seem to believe their own strategy is the key driver. They talk about their Vision 2027 plan, building a bigger, better, bolder McDonald's. They're aiming for an 18–20% operating EBITDA margin by 2027 and hitting that 580–630 restaurant target.
Ambitious targets?
Very. And they linked it back to SSSG. They said if they can get high single-digit SSG, think around 7% for maybe a year and a half, they believe they can hit the lower end of those profit margin targets. So the growth in existing stores is really the engine they need to fire up.
So that confidence, even with market softness, it really rests on their belief in their core stuff, right? Burgers, chicken, coffee, and the digital side.
Exactly. Those core categories are strong. The digital omni-channel model works. And critically, this big push they're making in the South, they see those three things, core menu, digital leadership, and fixing the South as the levers, the things they control that can drive that SSSG growth needed for Vision 2027. It feels less like waiting for the market to lift them and more about executing their own specific plan.
Okay, so wrapping this up, for you, the listener, what's the big takeaway here? Westlife Foodworld's Q1. It really shows a company trying to navigate carefully, right? Market's tricky, maybe stabilizing, but they're making very specific bets. Digital, supply chain savings, and especially that big push into the South, all while trying to keep that value message strong.
Yeah, it really highlights how even big established players have to keep innovating, keep adapting. It's a balancing act, isn't it? Managing today's profits while investing smartly for tomorrow.
It really is.
Yeah.
So maybe next time you're thinking about grabbing a quick meal, just consider all that strategy, operations, consumer insight playing out behind the counter. What really stands out to you about how they're juggling growth and profit right now?
And maybe a final thought to chew on. Given their confidence, their ambitious 2027 goals, despite the current softness, how might their intense focus on, holistic value and really drilling down into regional differences, how might that change the game for QSRs in India? Could it force competitors to get much smarter about value and much more localized in their approach too? What does that mean for how other businesses need to adapt? Something to think about.